Yes, please. Good morning. I hope all of you are feeling fine. Good morning to all of you. So, what all topics we had discussed yesterday? Anybody? We finished off with audit and auditors. Correct, sir? We finished off with auditor and auditors. We finished off with yes, sir. Then we also finished off with accounts of company. Two major chapters. And what we are discussing today is prospectus. I think prospectus I had started yesterday. Yes, prospectus basics we had completed yesterday. Today we are going to continue with that further. So the last point that we had discussed was the definition of prospectus. Am I correct, sir? So basically, what is a prospectus? Prospectus is an offer document. It is a notice. It is a circular. Okay, it is an advertisement which is issued to the public to subscribe for the securities of the company. And then I think we had also discussed about something called as a shelf prospectus. Okay, something called as a shelf prospectus. Yeah, what is a shelf prospectus, sir? Anybody would like to answer this question? What's a shelf prospectus? Section number 31. A shelf prospectus is nothing but if there are more than one issues in a year over a certain period. Yeah, if there are more than one issues, come on, everybody will participate, everybody will reply. Where are all the people? Come on, everybody has to reply. Aditi, Srinidhi, where are you? Meghna, Pratiksha, Rajeshwari, everybody has to reply. Come on, what is a shell prospectus? Jayesh, very good. A shell prospectus is nothing but it is a prospectus which is issued for certain classes of securities, and it is used for generally more than one subscriptions. So if those more than one subscriptions happen in a certain period, then we can have a shelf prospectus. Yes, very good. Yeah, and it has a time limit. Very good answer. Who said this? Yes, very good. Aditi, very good. So it has a certain time limit. And can you tell me what is the time limit? Yes, very good. 1 year. So why do you think that the companies require, what is the need for having a shelf prospectus? Okay, the need for having a shelf prospectus is that since you are going to issue these securities again and again, unnecessarily you may have to take approvals from ROC, okay? Get your prospectus registered with the ROC. So a lot of compliances are there, correct or not? So to overcome those compliances, going through the cumbersome exercise of doing a lot of compliances, it is better to issue a self prospectus. But one must not forget the fact that if a shelf prospectus is issued and thereafter there are some major events taking place, like if I can give you some examples of some major events, such as you can say that if there are some major events taking place like the mergers and acquisitions, like the board of director of the company has resigned, some new director has come. Yeah. So to cope up with those events, we give additional information. Yes, Jayesh, very good. Aditi, very good. Yes, Vineet, very good. Superb. Like this way, please participate in the discussion. If you'll say in the class, you will remember all the points. So there are some major events which have taken place. So for coping up with all those material facts, all the new changes which have come, why we need to inform those things to the prospective shareholders. So if a shell prospectus has been issued, we can't say that uh, you completely rely on the shell prospectus. But in case if you want to rely on information memorandum, you can rely on the information memorandum to know about the material facts or the important events that have taken place. So along with the shell prospectus, the important events also occur, simultaneously. So moral of the whole story is that if you want to inform about some important events, then you can issue an information memorandum. Everybody agrees with this point? Everybody agrees till here? Okay. So whatever changes have taken place, you can inform the parties through a information memorandum. Correct, sir? And let me tell you that see, there is one MCQ given there in the module. If you come to page number 3.21, there's an MCQ given. This MCQ is a little different type of MCQ. That is why I'm discussing, not usually known to the students. An applicant who made an application for the allotment along with the advance payment of a subscription, if he expresses a desire to withdraw his application after changes reported in the information memorandum that came to his knowledge. What a fantastic point. What a fantastic. I just like such type of things. So what they are saying, that the applicant had read the information memorandum, okay, and he was having a view about the company when he had applied initially for the under the shell prospectus. Now, after reading the information memorandum, he came to know that some major event has taken place, some material fact he came to know about the company. So something like, some management person, senior management person had resigned from the company. So when he came to know about the material facts and the events, at that time, what he did, he wanted to withdraw from the application that he had made under by reading the information memorandum. So if you read the question, he expressed his desire to withdraw after the changes that were reported in the information memorandum. So can he withdraw? Now, if he wants to withdraw, what are the options that the company can give him? The company may refund his monies at the discretion of the board of director. The company shall refund the monies after deducting some administrative charges within 15 days. Shall refund all the monies received under the subscription within 15 days, and shall refund monies after deducting the administrative charges within 30 days. Come on. You all people in your basics, you study issue of shares chapter, in which you people study that when the investor makes an application, then there is an allotment stage, then there is a call stage, then if some person commits a default, then his amounts are refunded. So tell me, is it the worthwhile thing about the company to refund with his money along by deducting some administration charges? Yeah, definitely not. This is like a very basic, when you understand the concepts, it looks like a basic question. Okay, so this MCQ we are practicing today. I thought of discussing this MCQ with you. Yeah, so what should be the correct answer, sir? Correct. Sushmita, very good. Aditi, very good. Like this way, please participate. So his entire money will be refunded. All the monies will be refunded within 15 days. So please underline. They can make another MCQ in this MCQ itself, that what is the time limit for refund. So I'm telling you that the time limit for refund is 15 days. Okay, that's why we are discussing this point. Tell me, is it clear, sir? Understanding, everybody? Perfect. Yes, sir. Can I go to the next point? So shell prospectus is clear to all the people? Yes, sir. Please, everybody show me thumbs up. Yeah, like I feel that I'm talking to 5-6 people only. Yes, sir. Please, everybody should show that thumbs up. Come on. Yes, Shushmita, very good. Everybody. If you'll show me the thumbs up, I will discuss more things. Yes, why many people are silent? Please show me the thumbs up. Come on, you should reply to the teacher. Don't do like this. Yes, Vinith, very good. I hope everybody is awake and nobody is sleeping. Yes, Aditi, very good. Rajeshwari, very good. Come on, everybody. Please read Shell Prospectus. Please read, go through it, please. Information Memorandum. Namrata. Yes. Rashmita, very good. Srinidhi, silent today. Kriti. Srinidhi, where are you? Achal, Rajeshwari, Aditi. Trupti, yes. Ujita, very good. Varsha. Okay, so tell me. So now, yeah, I hope you are having a good morning today and how your studies are going on. Studies are going on good. Nice. Company law, please ask me anything, any queries, any concerns you have, please ask me. I'll be more than happy to help you in company law. Okay, please ask me any doubts if you have. Okay, everybody should score exemption. I have told you this earlier also. Come on. Have you read the information memorandum? Yes, very good. Keep your confidence high, be peaceful, keep your mind calm. Come on. Have you read information memorandum? Can I proceed with the next concept? Red herring prospectus. What is a red herring prospectus? Tell me. Red herring prospectus. You know what happens? Usually when companies come out with the IPO for the first time, so that time they are not able to judge the price at which the investors are going to subscribe. Okay. So when the companies come out with the IPO, they are not able to judge at what price the investors are going to subscribe their IPO. So what they do, they come out with a red herring prospectus. They come out with a red herring prospectus. So what is a red herring prospectus? In the red herring prospectus and the main prospectus, there are only two differences. The first difference is that the price that is given in the main prospectus and the quantity of shares that is given in the main prospectus are unavailable in the red herring prospectus. Okay, so in the red herring prospectus, the quantity is not there, the price is not there. So what happens when these companies come out with the initial public offer? They they tell the public only to quote the price at which they want to subscribe the share. They want to elicit the demand. They want to calculate the demand for the securities that they will have when they will offer such securities in the market. Okay. So that time they will issue a red herring prospectus. That time they'll issue a red herring prospectus. So red herring prospectus is nothing, but it is like the main prospectus. It's similar to a main prospectus. Only thing is two factors are missing. One is the quantity. The quantity is missing, and secondly, the prices are missing. Okay, so one, the quantity is missing, and second, the prices are missing. So if I read this point, what is a red herring prospectus? Section 32. Red herring means it does not includes the quantum or the price. Complete particulars about the quantum or the price. Okay. And if you look at this point, need for a red herring prospectus. Why there is a need to issue a red herring prospectus? Because they want to ascertain. Suppose if I charge Well, let's take 2000 rupees per share. And if I'm a new company, then the shareholder will say, sir, it's too high. I can't pay so much. Okay. So that's why companies first find out how much the shareholders can pay. So they appoint some investment banks. They appoint investment banks like Morgan Stanley, JP Morgan. I'm sure you must have heard these names, Nomura. So these are the investment banks which are appointed who will discover the prices for the. So they go and do market surveys and then they discover the prices. And after the prices are discovered, then they calculate a cutoff price. And that cutoff price is written in the main prospectus, which is subsequently issued. So always remember that the red herring prospectus is issued beforehand, and thereafter the subsequent prospectus is issued. So both prospectus cannot be issued. So first is the red herring prospectus, then is the main prospectus which is issued. Also, let me tell you that the need for red herring prospectus, most favorable market price, they have to ascertain. They have to see whether the company can, issue securities. The market conditions are favorable for the company to come out with the security issue. Okay, so all these conditions they have to check. And red herring prospectus is always issued prior to the main prospectus. So main prospectus will be issued thereafter. First, red herring prospectus is issued. Then, if you see when do you have to file the red herring prospectus? Now, MCQ can come from here on this segment. The MCQ can come that you have to file the red herring prospectus at least 3 days prior to. So the company proposing to issue a red herring prospectus will file with the ROC, with the registrar, at least 3 days prior to the opening of the issue. Okay, so you have to file this at least 3 days prior to the opening of the issue. And the obligation under red herring prospectus shall be highlighted. So the main prospectus will also contain the details of red herring prospectus, that initially we had issued some red herring prospectus and thereafter the main prospectus was issued. Okay. And the price and the situation where companies issue red herring prospectus is basically called as a book building process. See, there is one paragraph given on book building. So what is book building? It is a price discovery process. When companies have to discover the prices, that time they come out with the book building process. Okay, so one price range is given, and in that price range only the investor has to quote the price. So suppose if I said 1500 to 2000, so now investor will say, okay, we can pay 1800, we can pay 1700. So within that only they have to quote the price. The range will be given, and that price discovery will be done by applying this method, book building method. And who are the people who are appointed? Underwriters. Okay, underwriters meaning the investment bankers. Investment banks do multiple tasks. They do underwriting, they do price calculation, they draft the prospectus for the companies. Okay, a lot of things. They structure the entire initial public offers for the companies. So that is the job of the investment banks. Okay, so they act as underwriters as well. I think red herring prospectus, I have explained everything. Please go through it fast. Then we are discussing the next kind of prospectus, which is called as abridged prospectus. You know what is an abridged prospectus? Abridged. Have you heard about this term, abridged balance sheet? Anybody has heard about abridged balance sheet? Yes, Shashank. Yes, very good. What is an abridged balance sheet? Like if I have to ask you, what is an abridged balance sheet? An abridged balance sheet is nothing but it contains, summary balance sheet. Very good. So nowadays, the investors are very busy. Correct. Very good. Yeah, it is an actual balance sheet, Bharat. You're right. But it contains less details than the main balance sheet. Yeah, it only contains the salient features of the balance sheet. Correct, correct. Very good. So in the same way, yes, Srinidhi. Hi, Srinidhi. How are you? I saw your answer. Very good. So this is a basically, and abridged balance sheet is a summary balance sheet. Okay. So in the abridged balance sheet, what details are written are only the summary, the salient features are written. Not everything is not written, only the salient features are written. So that's why this prospectus also is like that. So abridged prospectus, only salient features will be written, not everything will be written. Because see, investors are so busy. If I ask you to read 100-page prospectus, nowadays companies have 100 pages of prospectus, the fat prospectus they'll issue. Do you have that much time? Do we even need to read that much? Not required, sir. basic things we should know about the company, how it is. Investor confidence should be uplifted. That is all, you have to read in the prospectus. You have to see EPS figure. See, if I apply for many IPOs, so I'll just share my experience. So I read the EPS. Main is the EPS of the company, past EPS, then past dividend, the history of giving dividends to the shareholders. Then, the financial figures, some important figures like profit figure you should see. You should see the taxation that the company has contributed in the government exchequer. Now in prospectus, it is compulsory as per SEBI regulation that you have to print the balance sheets also, like past 3 to 5 years balance sheets are printed. So assets you should see. Then liabilities, check whether company has any major obligations to pay. So these all things you have to basically check. So that is more than sufficient. You don't have to read everything. Okay, like everything. Promoters history you can check. Like, are the promoters terrorist people, or are they some sound track record of integrity, honesty they have? What kind of people they are? So just basic things you have to check. So these all things will be scanned, and they will be put in a small prospectus, which is called abridged prospectus. So section, how the word abridged is defined. So section 2, subsection 1, abridged prospectus is means a memorandum. It's like a memorandum which contains salient features of the prospectus, and this is now specified by the SEBI, that is Securities and Exchange Board of India. Securities and Exchange Board of India. What is an abridged prospectus? Abridged prospectus is nothing but it is there to cut the cost. Why abridged prospectus is issued? Please underline that point, highlighted point. Cost cutting. Sir, nowadays paper is unnecessarily. Why to waste paper? Why to cut trees? And I think I say this in the lectures also, that my regular classes also, that paper, don't waste paper. So cost cutting is major important factor, since large number of investors should have the access to the prospectus, and cost cutting is important. Therefore publication cost can be saved. Okay, and you can just send it by making a PDF file to all the investors. Those who are willing to apply will apply in your company anyways. Correct or not? So for majorly for cost cutting reasons, we prepare this. And effective reading, if I want to add one more point to the answer, it is effective reading. The investor can only focus on the key points. Okay, that is one major reason. And then if you see abridged prospectus, abridged prospectus is also a bona fide application. Don't think that if a company is giving abridged prospectus, then it is not a bona fide application for share issue. You can still apply for the share issue. Okay, even after reading the abridged prospectus, you can. It is like as good as a main prospectus. So if I apply for a public issue by reading abridged prospectus, it doesn't mean that I have not fairly applied. I have still fairly applied for the issue. So abridged prospectus is just like a main prospectus only. So yeah. What is the major difference between abridged prospectus and red herring prospectus? See, abridged prospectus is a summary prospectus. Okay. Whereas a red herring prospectus is a detailed prospectus, except two details missing. So if I say it's a 100-page prospectus, then abridged prospectus will be 20-page prospectus. But red herring prospectus will be still 100 pages. Answering your question, Shashank. But okay, sir. Yeah. So that is the main difference. So everything is there, but only thing is just to elicit the demand. And in abridged prospectus, the price will be written, the quantum will be written. If you draw the distinction in the T form, the price will be written, quantum will be written. But in the main prospectus, in the red herring prospectus, the price and the quantum will be missing. That is the main difference. Okay, sir. Have answered your question. Yeah. So what if the company is making any default in compliance of this section? Then what is the penalty? So 50,000 rupees for each default will be the penalty charged on the company. Okay. So subsection 3 further states that 50,000 rupees will be the penalty charged on the company for abridged prospectus. So please underline the penalty figure. It can come as a 1 mark MCQ. Yeah. So tell me, Ubrimai Fidais. Okay, Ubrimai Fidais. Have you heard this phrase anywhere in your CA Foundation law? Misstatement in prospectus. Now we are discussing the next concept. Yeah, Ubrimai Fidais. Have you heard this? Utmost good faith. Okay, Latin word. It is a Latin word. Tell me, should the prospectus contain any false or misleading information, or it should contain true and fair information? Who will answer? Should the yeah, yes, Vineet, very good. Prospectus should contain true and fair information. Very good. Yes. So, correct. Meghna, very good. Superb. Sushmita, very good. So, prospectus should always contain true and fair information. Correct, sir? But, companies nowadays, they play with innocent investors' money. They cheat the innocent investors. Okay. So, if the prospectus contains any false information, or if there is any misstatement in the prospectus to do some scrupulous activity, or to enter into some connivance to mislead the investor, they give false information in the prospectus, then there is a section in Companies Act, that section 34 says that there is a criminal liability on the company. Okay. It is regarded as an offense. Now, when the authority will view the offense, they will decide whether it's a criminal offense or whether it's a civil offense. Okay. So, what are offenses? There are two type of offenses. Offense means something that is wrong. Any wrongdoings that you do is called as an offense. It may be a civil offense or a criminal offense. And what is a civil offense, sir? When the damage is caused to an individual alone, it's a civil offense. But when you damage the whole society, when the whole nation gets affected, or the larger group of people gets affected, it's a criminal liability. Okay. So that time, this prospectus, if it is misleading, it may be either a civil misleading prospectus or a crime. It's a crime if you mislead the investors. So that time your scrupulous activity will be looked into, and then the authority will take the call. What are the consequences? What are the remedies available for the investors for showing any kind of misstatement or misrepresentation in the prospectus? When can I say that the prospectus is misleading? Okay. If you see what construe a misstatement or a misleading prospectus. So if you see anything that you state is false information, not a accurate information, okay, then it's a misleading prospectus. Anything that you state is a wrong impression on the mind of the investor. An investor reads that, an investor goes and applies for the shares of the company. That's a misleading prospectus. So anything that you state is false, wrong information, gives a wrong impression about the actual facts. So actual facts are something different, but they are shown something else in the prospectus. Okay. So that is a misleading information. Any misleading word you write in the prospectus, you promise the investor about the returns. No, 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 no. If you invest in our company, we will give you, 40% returns and 80% returns. Some promising returns, no, not allowed, sir. You can't promise returns. How can you say that always the company will give assured returns to the investors? Nobody can promise returns by in a prospectus. So when company promises the returns, they are just fooling the investors. Now see, until I didn't tell you this, that companies should not promise returns. Suppose if you're a layman investor, you just simply go and read a prospectus, and one company writes there that, sir, I'll pay you 40% return. You will feel inclined that, okay, let me put some money. Okay, so that I'll get 40%. Banks usually gives 7-8%. This company is giving 40%. So don't promise any returns to the investors. Okay, let it be free. Okay, if they want, they'll come and apply. They'll look at your background and they'll apply. So including any false statement, omission, hiding some facts, okay, commission, or sometimes both, wrong impression. This is called misstatement prospectus. So this is all misleading information that you give in the prospectus. Okay. So when prima facie, when the prospectus looks good, then it is a misleading prospectus if the actual picture is not like that. So you see, there are some landmark judgments given. There are some landmark judgments given on misleading prospectus. I will read the first one, the Henderson versus Lacon. Misleading through a false statement. So in this judgment, the prima facie facts were like that there was a misleading statement, false statement given. It was stated in the prospectus that the director and their friends have subscribed a larger portion of the capital, and now they offer to public the remaining shares. I clearly say this in the class also, that first, shareholder confidence will increase when promoters of the company, directors of the company, they start subscribing the shares. And you will not believe it, that the SEBI has a regulation that first 20% of the IPO contribution should be coming from the promoters, and then the remaining contribution can be 80% can be from the public. So that first 20% comes before public issue opens. Are you aware of that? In the SEBI regulations, there are some regulations called as ICDR regulations, issue of share capital and disclosure requirement regulations. In that, it is written that firstly, the promoter's contribution has to come, and thereafter the public contribution can come. So imagine, they are fooling the investors by writing this statement. In Henderson versus Lacon case law, it is given that the directors have applied, their friends have applied, relatives have applied, and now you also should apply for the remaining shares. Whereas actually, in reality, what was the case? Let us see that also. Each director had only subscribed for 10 shares. Okay. And it was held that this statement is a misleading statement. So I hope now you're understanding that what is misleading information. So when you're hiding some statement or giving some false facts, then it is called a misleading information. Or you're hiding some true facts. Like if you see this one, Rex versus the Clesant case. Okay, Rex versus the Clesant case. It also says the same thing, that in prospectus it is stated that the company has been regularly paying. I told you, check dividend records. See, in fact, I read these case laws, but in my mind only it is fitted that when I apply for any company's IPO, I will always see what is the past track record of the dividend. How can you just go and apply your hard-earned money, for your hard-earned money? So you have to read the past track records of the of the dividend. So what I said just now is actually written in the form of a case law here. So it was stated in the prospectus that company is very much regular in paying dividend, and company has been, but in actual, what was the case? See, the company has been incurring substantial losses. Okay, and in all those years, and the company has is used to write back some of the past provisions to the credit of the P&L account. And it was held that the prospectus did not disclose the true picture of the company in Rex versus the Klassen case. So all these case laws can be put up in the form of a case study. Okay, that's why I'm just discussing the crux of the case. So always remember, don't put any ambiguous statement, any false or misleading statement in the prospectus, because then it affects the mind of the innocent shareholders. Okay, using some extravagant terms, some flattering descriptions. You're trying to flatter the shareholders by saying that we are doing this, we are doing that, and we are putting some key information. So don't do all such things. It is misrepresenting the people. Now, what are the remedies available for such misrepresentation? If you come to the next page, what are the remedies which are available? Tell me. If when I say remedies, company against the company, so company can cancel the contracts. Okay, if the company wants, company can cancel the contract. Damages and against the company and others. So a company will be chargeable for civil liability, criminal liability. Criminal liability will generally devolve on the person, and civil liability on the companies. Usually that happens because company is an artificial person. Come on, you study in foundation. Company cannot be imprisoned. Okay, company cannot marry. Company cannot be imprisoned. Okay, so these all things. So civil liabilities on company, that is fine may be imposed, compensation will be imposed, and those who are the persons in charge of the company lifting the concept of corporate veil. Okay, criminal liabilities can be devolving on the person. Okay, so these are some of the remedies for misrepresentation in the prospectus. Yeah, which the shareholders have. Yeah. No. In that has to be proved that the misrepresentation is unintentional. Unless it is not proved, then definitely it will devolve under an offense. Okay, so you have to prove it. The directors have to prove it to the satisfaction of the authority that the misrepresentation is unintentional. Okay, then who can seek for a rescission? Right of rescission. Of course, I applied for the shares by reading the prospectus, but now the prospectus is only false. So can I rescind the contract? Who can rescind the contract? Let us see. Rescission meaning cancellation of the contract. A person who has purchased the shares of the company on the basis of the prospectus, which contains a untrue and a misleading fact or information, that fellow can only go for a rescission of the contract in the court of law as per the provisions of the Indian Contract Act. So see, fantastic point. This is case study. This is case study point, sir. Okay. I don't know if you have the case studies with you. Let me just open one case study. You were given the sheets. Were you given the sheets, case study sheets, everybody? The soft copy which I had sent yesterday? No? Okay, so immediately after the lecture, I will forward it. Now, as of now, you can just see the screen. Immediately after the lecture gets over, somebody remind me, I will forward it. You will get it, don't worry. See, these were the case studies I had made specially for you. I wanted to show you one case study. Yeah, this one on prospectus. Yeah, we received it. Shushmita is saying we received it. Those who have not received, you will get it. Don't worry. You will get everything. Main objective is that you should pass. Okay. So just have a look on this point. See, no, Sushmita, who's doing that? Don't do that. Main objective is that you should look at the case study and understand what it is. Yeah, anybody who's a reader in the classroom who wants to read? Anybody who's a reader in the classroom? Any student interested? Yes, who's reading? Please tell.
Sir, I am reading, sir.
Yeah, Shashank. Yeah, very good. Start
Sir,
reading. Question number 2.
Wait, sir. MNP Limited is a registered public company having the following: directors and their relatives 18,
You have to read it
employees
from
26.
Shashank, you have to read it from the question given on the screen. Is it available on your screen?
Yes, yes, okay, sir. Okay.
Question number 2.
Okay. XYZ Limited issued a prospectus inviting the public for subscription of its equity shares, stating it in that company possesses good financial health and paying dividend to its equity shareholders consistently and regularly at 20% over the last 5 years. The fact was, company was running in loss since last 3 years and it was paying dividends to its shareholders out of accumulated profits. Mr. Amit read the prospectus and bought 500 shares from the company. Discovering the misstatement made by the company in the prospectus, he wants to resign the contract and claim the damages from the company. Referring to the provisions of the Companies Act, decide whether Mr. Amit will succeed.
Tell me, can I say just now same case study from the module I explained you? Yeah. And the same case study I have drafted in the form of a question. Okay. See, this way question will be drafted. Yes, sir. Same case study. Just now we discussed, if you remember, I was discussing the Clescent case, the Rex versus Clescent case, and the reference of the case law also I have given here, if you can see. So I think Shashank can read the answer now. Are you there to read the answer?
Sorry. The prospectus is misleading since non-disclosure of the fact that the company was making losses and that the dividends were paid out of past years will give a false impression that the company was making profits. Since suppression of such fact might have affected investors' decision to subscribe for shares. Since the prospectus does not disclose all the material facts truly, honestly, and accurately, the allottee of shares is entitled to resign the contract of allotment of shares if he had relied and acted upon the prospectus. That is, he subscribed the shares after being influenced by a misleading prospectus. Bracket Rex versus Clysant.
Tell me, did you understand the case study? Okay, this is the way there were two concepts covered here. Okay, there were two concepts covered here. One was rescission, which I was just now reading, that whether the investor can rescind the contract after applying for the prospectus. And what was the second thing? What was the second thing given? The second thing was the Rex versus class and case law. So moral of the whole story is, this way they will pick up some points from in between the notes, the study material, or whatever I'm discussing in the class, and they'll make a case study like this. Okay. For your kind information, this case is not there in the module. This is like, I've made all these case studies. Some case studies, of course, I've taken from the module. Some I have made on my own. So this way the case studies are drafted. Tell me, have you understood or not? Are you getting familiar? Yeah, see, Shashank, if you want to state the penalty, you can state. The question is not on the penalty. The question is basically on whether the contract can be rescinded or not. So the question is on right of rescission. Okay. If you additionally want to quote penalty, penalties can be quoted anywhere and everywhere. Penalties, if they ask you a specific question on penalty, then yes, you have to state the penalty. Otherwise, Shashank, penalty is not required. You can, the question is on rescission of the contract. Are you getting it? Yes. Now, there are some exceptions given on page number 3.27. Can you come to the exceptions, please, everybody? When right of rescission is not available. Now, tell me, I was discussing a point where case can be rescinded, where contract can be rescinded. But when is the right of rescission not available? Tell me, right of rescission is not available, or right to rescind the allotment is not available if the shares are subsequently purchased from the market. That means in this given question, if the shareholder would have read the prospectus and purchased the share, then right of rescission is available. But if the shares are subsequently purchased from the market, and then the shareholder claims that no, your prospectus had stated something wrong information. Okay, but I am purchasing shares afterwards, but I did not read the prospectus. I purchased it from the secondary market, but then your prospectus contained wrong information. So can the shareholder say like that? Will the shareholder get a right of rescission? Tell me yes or no. The shareholder won't get right of rescission. Okay. So rescission is only available. Yes. No, sir. Rescission is only available when the shareholders are reading the prospectus and applying for the IPO. And then subsequently, if they get cheated, then the shareholder can claim for rescission. So what are the exceptions to the right of rescission? Remember, this can come. The right of rescission is available or is not available when the shareholder purchases shares from the open market, and the subscriber to the memorandum cannot seek any relief, as the company cannot be considered in exercise at the time when he appended all his signatures on the memorandum. He cannot be said to have been influenced by the statement in the prospectus. You are a subscriber to the memorandum. Can I say memorandum have 5 clauses? The last clause is the subscription clause. Once you subscribe for the memorandum of the company, once you are subscribing for the memorandum of the company, tell me, you have already signed the memorandum. Now, whether you read the prospectus or not, does it make any difference? You're the subscriber to the memorandum. You have to buy the shares of the company. So you can't say that you were influenced by these statements which are used in the prospectus, because you are the subscriber to the memorandum of association. Have you understood or not? Tell me, are these points clear to everyone? Rescission is clear. Rex versus Classen case law is clear. Yes, sir. Fantastic. Very good. Okay. Now, one more point is there. Now, let us discuss section 35, which I feel is important section in module. Please mark section 35 important. Civil liability. What is civil liability? So, as I said, civil liability meaning that particular individual is getting affected. Okay. So, any loss or damage which is made to the subscriber of the securities as a consequence of acting on the basis of some, see, clearly language is clear, sir. It is clearly saying that the subscriber is acting on the basis of any false information in the prospectus, any omission in the prospectus. So he's acting on the prospectus, matter given in the prospectus. So definitely that point makes it clear that he is not acting afterwards, not in the secondary market. Just by reading the prospectus, primarily he is acting on that. So if the statement is misleading, then who is liable for the penalty? Penalty will be devolving on the company. Every person who is the director of the company or who has authorized himself to be, so that his name can be written in the prospectus. Promoter name can also come in the prospectus. Promoters, one of the way to identify that who is a promoter of the company is by writing his name in the prospectus. So promoter name can be written in the prospectus. Any authorized person's name is written in the prospectus. Any expert name is written, any merchant banker or any calculator, any valuer, registered valuer whose name is written in the prospectus, that person can be liable for punishments. Okay. And liability for the offenses. So when a person is found guilty under section 35, what is the liability? Okay. He has to do the since it is a civil liability. I think in the chart also I showed you, for civil liabilities, usually compensation is more than sufficient. He is liable to pay the compensation for the losses which are suffered. Okay, sir. Can he exceptions to the liability, exceptions to the offense under section 35? That is, civil liability has evolved, but there are some exceptions. So the person can withdraw his consent to be the director of the company. So suppose if I say that the director was penalized, okay, the penalty should devolve on the director. But if the director has withdrawn from the company, or he has withdrawn his name to be written in the prospectus, then penalty cannot devolve on such director. So if you look at the exception points, if he withdraw his consent to be the director of the company and the prospectus was issued without his consent, then you cannot charge the director for that. Okay. Or if the prospectus was issued without the knowledge and the consent of any person who was the responsible person, but and a reasonable public notice was also given that we are not having the knowledge of the prospectus, then also you can withdraw. Then any authority of the expert, any expert who is there, if he made a statement on the authority of the expert who he believed is a competent person. So if something is written in the prospectus and the expert had made that statement, or somebody on behalf of the expert had made that statement, then you have to catch the expert, not that director. Okay. Director will say, I am not the expert, but expert told me to make that statement, so I made that statement. So then the sword will fall on the neck of the expert, not on the director. If he had reasonable grounds to believe that the statement is true, and if the statement was correct copy of the some extract of the official document. So there was some government press release or some government notification come, and on the basis of that notification, official document only, that statement was made. So these can be regarded as exceptions where the liability will not devolve on the person directly. Okay, you can escape but you have to prove all these grounds in front of the authority. Yes or no? And if a personal liability, when the intention is to defraud, sir, please mark it important. Unlimited liability concept. If your activities are scrupulous in nature, okay, defaulting activities, trying to cheat the innocent investors, then personal liability can devolve without any limitation of liability. So unlimited liability without any limitation of liability, meaning unlimited liability for any damages, any losses on the subscribed securities. When the intention was to defraud the applicants, then personal liability can be devolved. Okay. Look at this question. Look at this question. Yeah, Shashank, are you available to read?
Yes, sir. Yes.
3.29 page. Illustration. A prospectus is issued. That question.
3.29. Okay. A prospectus is issued by a company contains certain misstatements. On becoming aware of the facts regarding misstatements in the prospectus, one of the experts, Anilesh, who had earlier given his consent, forthwith gave a reasonable public notice stating that the prospectus was issued without his knowledge and consent. Is it possible for Anilesh to escape liability for misstatement in the prospectus?
Tell me, what should be the answer? He had given a public notice that it was issued without his consent. So is it any possibility that he can escape the liability? Yes, sir. Who will answer this question before Shashank reads the answer? Yes, sir. Very good. Yeah. I think people have got the concept. Yes, Shashank, read the answer.
Section 35, subsection 2 of the Companies Act 2013 states that no person shall be liable under subsection 1 if he proves that prospectus was issued without his knowledge or consent, and that on becoming aware of its issue, he forthwith gave a reasonable public notice that it was issued without his knowledge or consent.
Yes,
In
sir.
the
Please,
case,
without his knowledge or consent. Please underline the word if he proves that. Sir, if it is an assumption that only if you prove it, then only you can escape. Otherwise, not. Yeah. Further.
the case of Anil is covered under the above exception provided by the subsection 2, and therefore he will escape liability for misstatement in the prospectus.
Yes. Very good. See, whatever we were discussing just now was civil liabilities. Okay, sir. Whatever we were discussing just now was civil liabilities. Now we are discussing criminal liabilities. So, criminal liabilities for the misstatement in prospectus. Tell me, criminal crime, the whole society, the whole nation is getting affected. Okay. So, under section 34, any statement containing untrue information, false or misleading information, and if that statement is circulated in the prospectus, any omission of the matter which is likely to mislead the investor, then, sir, the people who are signing the prospectus, they'll fall into trouble. So, who shall be liable? Every person who authorizes the issue shall be liable. Not only that, it will attract section 447 liability. Okay, you remember section 447? Everybody remembers that big section 447? That chart is there, tabular format. Yeah, please come to section 447 punishment. Page number 3.35, section 447 punishment, everybody. So tell me, what is the punishment under 447? Fraud less than 10 lakh rupees or 1% of the turnover, whichever is lower. Okay, public interest is not involved. What is the answer, sir? If public interest is not involved, what is the answer? Up to 50 lakh rupees fine and 5-year maximum imprisonment. Okay. Fraud at least 10 lakhs or more, public interest is not involved. Then equal to the amount of fraud is the fine, or 3 times multiplied by the fraud 3 times. And 6 months minimum imprisonment, since it is not public interest involved. Underline the word not. Not public interest involved, therefore 6 months imprisonment minimum, and maximum 10-year imprisonment. But if fraud in the question involves public interest, then 3 times the amount of fraud can be the maximum fine, equal to fraud or maximum 3 times the fraud. And the 6 months period is duration is raised from 6 months to 3 years. And 3 years maximum is always same, 10 years. Okay, we had discussed this in the class also, in the regular classes. Okay, coming back. So this is the penalty for fraud, criminal offense. It was written there. The section number 447 will be attracted for criminal offenses. Okay. So see, if you come back to the criminal offense, page number 3.30, section 447 gets attracted. Okay, sir. That is one point. Secondly, tell me, so criminal offenses and civil offenses can be in the form of that chart. In a civil liability, pay the compensation to the investor. You can withdraw your consent to be the director. Exceptions can be withdraw your consent, believe on the consent that the consent is true, and you had made a public statement, public notice, so you can escape the liabilities. Otherwise, you'll have to pay the compensation. And in case of criminal liability, every person who signs the prospectus will be punishable under 447 section. And you can escape. Still, there are defenses for criminal liabilities also. You can escape if that amount is too immaterial, too small amount of loss has occurred to the investor, immaterial amount, or if there are reasonable grounds to believe that whatever was written in the prospectus was true and fair. Okay. Otherwise, then you will have to suffer. So, can you understand the summary now? So, tell me, what is the consequences if there is a civil liability? What is the consequences? Pay the compensation. Civil liability, no imprisonment will come. Okay, remember. Criminal liability, yes, imprisonment will come. 5 years, 6 months, 10 years, and then you have 3 years and 10 years respectively. And the defense is you can escape by showing that the amount of damage is immaterial. So I think full point we are discussing. Shashank, there is one more question on page 3.31. Can you please read that also? An allotee. Allotee.
Yes, sir. An allotee of shares in a company brought action against the director in respect of false statements made in the prospectus. The director contended that the statements were prepared by the promoters and he simply relied on them. Is the director liable under the circumstances?
What they are saying, that the allotee had brought the shares in the company, brought against the action against the director in respect of false statement in the prospectus. So the allotee thought that the prospectus is true and he brought it. What is the director contending here? That the statements were prepared by the promoters and he simply relied on them. So now can the director escape the circumstances? The blame should go on the promoter. Yes. See, if the director proves it that there are valid grounds to believe what promoter said, he can escape. Otherwise, the director will be liable for the punishment. Yes, Shashank, can you read the answer? Director can escape.
Yes, the director shall be held liable for false statement made in the prospectus under Section 34 and 35 of the Companies Act 2013, whereas Section 34 imposes a criminal punishment on every person who authorizes the issue of such prospectus. Section 35 more particularly includes a director of the company in the imposition of liability for such misstatement. Certain situations when a director will not incur any liability for
Fine.
misstatements.
So though 2 points are written here. They are talking about director can be punished also. So this is the reason I'm discussing this question. You have to say that if director can prove it, he can escape. If he's not able to prove it, then he will be liable under 34 and 35. Okay. Both the ways. This is called writing diplomatic answers. Both the ways you have to write. Yeah. Read further.
But no such exception specified that relying on the statements prepared by the promoters of the company is valid ground for a director to escape from the liability of misstatement.
Actually, the question was on relying. No? He had relied on the statement of the promoter. No? So when you rely on the statement, when you have consented the promoter, then you can definitely escape. So even if the student writes, yes, the director can escape, and you can say that you have proved that it is the promoter statement on which you had relied upon, then full marks will be allotted for this question. But examiner would appreciate that if you write the section number 34, 35, civil liability, criminal liability, imprisonment will not be devolved, imprisonment will be devolved. And then you should say that the director should not be himself involved in the fraud. So, some masala you have to add. If you look at this type of questions, it's not that simply you can just write the direct answer. But even if you write direct answer, some examiners have maybe liberal enough to give you the marks, whereas the other examiner would say, no, the student has to explain both. Can escape also and cannot escape also. Then I will allot the marks. That way also they can ask you the questions. Fantastic, sir. Perfect discussion. Very good. Yes. Now, if you try to deceive someone, deceit meaning cheating. Underline the word deceit and write the cheating. Damages for deceiving someone, cheating someone. Okay, person responsible for issuing the prospectus will be held liable for deceiving someone under the law of the Indian Contract Act, section number 19, which is on cheating. This remedy shall be available even when the remedy by way of rescission against the company is lost, either through the laches or negligence, or even if the company goes into liquidation. So remember, underline the word company goes into liquidation. That means in all circumstances, if you have cheated somebody, in all circumstances, the investor, the allotee person will get the remedies. Okay, so even if you cheat someone, the allotee will be getting the remedy. And what are the prerequisites for the claim for deceiving? That the fraud misstatement related to some existing fact. You have to see this, all allotee has to prove it. this all allotee has to prove it that there was some false statement. So there was some fraudulent misstatement of the material facts. The allotee has been allotted the shares on the basis of original prospectus, and he has actually been deceived by the company by reading that prospectus. Unless you don't prove that you are actually being deceived by the company by reading that prospectus, then you cannot go for this type of claim, but you have to prove it. So claims for damages for deceit. So Peak versus Gurney, again new case law came, Peak versus Gurney. So Gurney issued a prospectus on behalf of the company. No shares were purchased by Peak at that time. Several months later or afterwards, Peak purchased 2,000 shares of the company from the stock exchange. So can I say this is a secondary market issue? You can't punish the company on a secondary market issue. You feel that you are cheated, then you should be cheated on the grounds of the prospectus, not subsequently by secondary market issue. So he brought the action on the director that he has been deceived on the basis of prospectus, and the court held that the directors were not liable on the shares that were purchased on the basis of the prospectus, because directors could be held liable if this fellow would have purchased the shares by reading the main prospectus. Have you understood or not, everybody? Tell me, is the discussion clear, sir? Perfect. All the people, everybody, come on, thumbs up. Thumbs up. Yes, sir. Very good. Okay, very good, Rajeshwari. So you people, I will give you one tip. You should do writing practice. Writing practice is important. Okay, all these case studies, right? After they are discussed, right? Do writing practice. There is one illustration given on page number 3.36. If Shashank, can you read it? Mr. Raju. Shashank.
Mr. Raju is one of prospective investors under Section 37 of this Act sue the persons who authorized the issue of the prospectus for fraudulent misstatements they made in the prospectus. Mr. Raju also filed a complaint under Section 420 of the IPC 1860 and Section 447 of this Act. Mr. Angad, one of the authorized persons, plead that Mr. Raju did not took any share, hence he has not borne any sort of loss. Therefore, he cannot seek the remedies for what he is asking for, and they are not punishable under Section 447 because fraud was not committed against Mr. Raju. Whether the persons who authorized the issue of prospectus punishable under Section 447.
What a fantastic question this is. See, is Raju the real purchaser of the shares or he is the prospective investor? Who is he? First of all, underline the word prospective investor. He is not the real purchaser of the shares. Okay. And now this company has put some false statement in the prospectus. So can Mr. Raju seek for some remedies? He's claiming that they'll punish the person because they have cheated, they have written wrong things in the prospectus. And Mr. Angad is there, who is an authorized person. He is saying that why Raju is filing a complaint on us under section 420 of the Indian Penal Code. Okay, 420 matter. So Raju had not borne any loss, but tell me, is it a civil loss or a criminal loss? Who is getting affected? If you put some fraudulent misstatement in the prospectus, who's getting affected? Fraud has happened. The whole society is getting affected here. It's a criminal liability. Yes, it's a criminal liability. Tell me if it's a criminal liability. Aditi, very good. If it's a criminal liability, yeah, then even if there is a prospective investor, that prospective investor will be held liable. Yes, criminal liability. I think we just now discussed this point. So I think all the people have got the answer. Can you read the answer, Shashank? Please read the answer.
In this case, the persons who authorize the issue of prospectus shall be punishable under Section 447 for fraudulent misstatement, despite the fact that Mr. Raju had not won any loss, because wrongful gain or loss is not essential constituent of fraud under Section 447.
So 447 gets attracted. It's not important that the investor himself should be suffering the loss. Mark my word, if it is a criminal liability, if it's a criminal liability, if it's a civil liability, sir, anybody wants to have any argument on Peak versus Gurney case law and this question that I discussed just now? Anybody wants to have any argument on Peak versus Gurney? Any argument on Peak versus Gurney? Nobody has any argument. Both the case laws are clear. In Peak versus Gurney, why that fellow could not punish the company? In Peak versus Gurney, why the company was not punished? Tell me, why Gurney was not punished by Mr. Peak? Anybody has any argument on that? Because the real reason was that several months later, when the shares were purchased, the prices collapsed, and because of which Mr. Peak suffered the loss. Okay, he did not read the prospectus and the fraudulent information and suffered the loss. So if you look at the facts of the case, yeah, it was in a secondary market purchase. Correct, Meghna, correct. So the prices collapsed and therefore he suffered the loss. Are you understanding or not? Yes. Tell me, coming to section 39, what is allotment of shares? Acceptance. You accept the shares are allotted by the company, they are supplied by the company, and you are you must have made an application for the shares, and now you are accepting. You all know that if you make an application, but if you do not pay the whole amount, then the same can be forfeited also. And then the forfeited shares can be reissued. I told you that if you reissue the forfeited shares, then any profit made on reissue can be transferred into capital reserve. Correct or not? So what is the minimum subscription? No company can allot the shares unless and until the minimum subscription is received. So underline the word. The first requisite for allotment is minimum subscription. Valid allotment is minimum subscription. Unless you don't receive the minimum number of subscribers. So there are different methodologies. Like in case of SEBI regulations, it is said that if 25% of the shareholders don't apply for the issue IPO, then the IPO cannot be subscribed. Okay. So minimum subscription should be at least minimum 25% public should be there. Presence of public should be there. So the valid reason for an allotment is subsection 1 says that minimum subscription should be received under section 39. No shares can be allotted unless at least so much amount has been received and subscribed, and the sums that are payable on application for the amount so stated have been paid and received by the company by check, any other instrument, from the subscriber or investors at the time of making the application. So the sums which are paid should be received by the company. Whatever check or whatever demand draft, other instrument can be like a demand draft, okay, DD. So money should be received, some payable should be received by the company who are making the, from the investors who are making the application. Then only we can say that the allotment can be made. So tell me 3 criteria for allotment of shares. Minimum subscription should be received. Minimum number of investors should be subscribing. and the money should be received from the investors. Very, very easy points. Now, quantum that is payable at the application stage. If you are applying for the shares, at least whatever is the original value of the shares, nominal value of the security, 5% of that or more you should pay. So underline 5% because that is a MCQ type question. Some other percentage can also be prescribed by SEBI. So see, when you talk about this IPO and allotments, definitely SEBI comes into picture. So some other percentage can also be specified by SEBI. And the minimum sum that is payable on the application should be 25 at least 25% of the issue price. If you see, SEBI regulations are written there. ICDR regulation reference I already gave you. Issue of capital and disclosure requirement. So if you look at the example, what they are saying, that if the share is listed of a nominal value 10 rupees, application money shall be at least 2 rupees 50 paise. Okay, and if the nominal value is 100 rupees, then application money should be at least 25 rupees. I think you must have understood that the ICDR regulation, if it is a listed company, then they can specify as per the ICDR regulation. Otherwise, the company law says that the minimum allotment money should be, application money should be 5% of the nominal value. So please underline both the points. 5% of the nominal value or as specified by SEBI. Both points will come. As specified by SEBI and 5% of the nominal value. Correct, sir? Time period for refunding the allotment money. Come on. We already discussed this point. 15 days. Time period for refunding the application allotment money. How much, sir? 15 days. Underline 15 days. Default in return of application money. So if the company is defaulted, then the officer, director will be jointly and severally liable to repay the money with a 15% per annum interest. 15% per, underline 15% per annum interest. Tell me, after the allotment is completed with the ROC, you have to file PAS 3 form, PAS 3, Prospectus and Allotment of Securities form number 3. And in how many days you have to file this form? 30 days. And whatever is the minimum fees, you have to pay the minimum fees as the registration offices and fees rules 2014 may specify. And along with the PAS 3 form, what else you have to attach? You have to do all the necessary attachments. That is the list of who are the allottees, their names, their occupation, addresses, how many securities are given to each and every allottee. That should be attached with PAS 3 form. They can ask you a short note on PAS 3 form. Then additional attachments, the duly stamped copy that the securities have been allotted, that can be an additional attachment. Contract of sale of securities, underline contract of sale, underline additional attachments. Then valuation report of the registered valuer, that can also be attached. If it's a other than listed, see, for listed companies, prices can be easily valued by the registered valuers. But for other than listed companies, you have to specifically hire a registered valuer who will do the valuation. So they can fix up the price. So registered valuer's report can also be attached along with PAS 3 form. If a short note is asked, sir, all these key points you can write in the short note. Penalty, 1 lakh rupees is the highest penalty, 1000 rupees per day of the default, subject to maximum 1 lakh rupees, whichever is less. So underline maximum is 1 lakh, 1000 rupees per day, whichever is less, penalty. Yeah, can you read this case study, Shashank? 3.41 page. After having received 80% of the minimum subscription. Yes, Shashank. Are you available to read?
Yes. Laksha did, huh? Raksha Detective Instruments Limited, before finalization of the allotment, withdrew 50% of the said amount from the bank for purchase of certain assets. Thereafter, it started allotting the shares to subscribers. Rashmi, one of the subscribers, was allotted was in equity shares. She, however, refused to accept the allotment on the ground that such allotment was violative of the provisions of the Companies Act 2013.
Hmm. Read the answer.
According to above examples, Raksha Detective Instruments Limited has received only 80% of the minimum subscription as stated in the prospectus. Since minimum amount has not been received in full, the allotment is in contravention of Section 39 subsection 1 of the Companies Act, which prohibits a company from making any allotment of securities until it received the allotment of minimum subscription stated in the prospectus. Further, under Section 39 subsection 3, such company is required to refund the application money received to the applicants. Therefore, Rashmi, within her rights to refuse the allotment of shares which has been illegally made by the company.
Yeah, so if the prospectus specifies that a higher percentage should be received from the shareholders, then if that much higher percentage is not received, then also the allotment can be refunded. So please come to page number 3.38 and mark that as per SEBI, how much is the minimum percentage given? SEBI has powers to state the companies that the minimum subscription can be even 90% of the entire issue. Underline 90%. On page number 3.38, as per regulation number 45, sub-regulation 1, SEBI can also state that the minimum subscription can be 90% of the entire issue. Okay, so underline. So in prospectus, sometimes companies write 70%, 80%, 90% also. So in that case, if that much is not received, what is stated in the prospectus, then you can refund. Everything can be. So Rashmi will be within her rights to refuse the allotment because the shares were illegally allotted by the company. Okay, sir. Tell me, are you following this point, everybody? Yeah, what is the commission that is payable to underwriting agents? If you come to page number 3.43, I want to discuss the commission. What is the commission? So what if the subscription is 90%? Yeah, if the subscription is 90%, then the question of refunding will not arise, no? Because then the company has done it has achieved its targets of receiving 90%. Whatever is, always remember that whatever is written in the prospectus, if that much is not received, then the company should refund application money. Always remember that. Is it clear, Shashank? Okay, very good. So rate of underwriting commission, tell me on shares how much it is, sir? 5% should not exceed 5%. Rate of underwriting commission, the maximum rate of commission can be 5% in case of shares, or any amount which is authorized by the articles. Yes, very good. And debenture, it is how much, sir? Anybody? Debenture, it is how much? 2.5%? Yes. Or any amount as may be authorized by the articles. Yes or no? So students are advised to remember 5% and 2.5% for shares and debentures, respectively. There is a good question given in the module, page number 3.44. Can you read that question, Shashank? Board of
The
Directors.
board of the, the board of directors of a company decide to pay 5% of the issue price of shares as underwriting commission to the underwriters. However, the articles of the company permit only 3% commission. The BOD further decide to pay the commission out of the proceeds of the share capital. Are the decisions taken by the board of directors valid under the Companies Act 2013?
Yeah, articles is saying 3, but the BOD decided to pay 5. So can they exceed the articles or whichever is less? Can they exceed the articles or whichever is less? Yeah, whichever is less. Very good. Please read the point. Whichever is less. Very good. Read it, Shashank.
Under Rule 13 of the Companies Prospectus and the Allotment of Securities Rule 2014, the rate of commission paid or agreed to be paid shall not exceed in case of shares 5% of price at which the shares were issued or rate authorized by articles, whichever is less. The same rule allows the commission to be paid out of the proceeds of issue or profits of the company or both. Therefore, the decision of board of directors to pay 5% commission to the underwriters is invalid since the same cannot exceed the rate permitted by articles. However, the decision to pay commission out of the proceeds of sales issue is valid provided it is paid at rate authorized by the articles.
Very good. Excellent answer. Market important question. This type of question can come. Market important question. So then there is a GDR issue, Global Depository Receipts. So Indian company wants to issue shares abroad, so it can go through the wire route. It can appoint a custodian, keep the shares with the custodian. Then the custodian will enter into the agreement with the overseas depository, and the overseas depository will issue shares overseas on behalf of the Indian company. So once these global depository receipts are converted into equity shares at a later stage, if there's a conversion option given by the company, then the GDR holders will even have voting rights. Okay. So if you come to the page number 3.46, voting rights, the GDR member may be having voting rights only if upon the conversion of the global depository receipts into underlying shares. So once the GDR gets converted into equity shares, then only the voting rights will be given. Otherwise, GDR holders don't have voting rights. Okay, please remember this. Then comes private placement, our favorite, private placement section 42. So maximum private placement offer can be made to not more than 200% in a financial year. Okay, not more than 200% is the key point. So if a company makes a private placement to more than 50 individuals also, but if in the entire financial year, if it is less than 200 or equal to 200, then the private placement offer is valid. If it exceeds 200, then it becomes a public offer. Are yes or no? If it exceeds 200, it becomes a public offer. Private placement can be made to the equity shareholders for giving the equity shares. It can be made to the outsider selected investors, selected group of identified persons. Qualified institutional buyers, employee stock option schemes will be kept outside the purview of private placement. Then I think we also know who are QIBs, all the mutual fund, insurance companies, all the big Bs, okay, big investors are QIBs, qualified buyers. Then earlier it was written that originally section 42 subsection 2 contained a limit of 50 or such higher as may be prescribed. But then there was a second amendment which was inserted in 2018 under the second amendment rules 2018, which said that now invitation under private placement shall not be made to 200 people aggregate in the financial year. So even if there was an earlier rule of 50, now the rule has been restricted. So if I make to 52, 53 per private placement offer, it's okay, but it should not cross 200. Okay, so fourth point I'm marking important. Then the aforesaid rules will be reckoned for only equity shares, debentures, and preference shares. I think that also you people know that private placement can be made only for equity shares, convertible preference shares, and convertible debentures. Okay. And then NBFCs which are registered with the RBI, housing finance companies which are registered with the National Housing Bank, if they are complying with the regulations made by the RBI, then in respect of an offer or an invitation to be issued under private placement basis, need not comply with rule number 14 sub rule 2. So in simple language, NBFCs and HFCs also can make private placement offers in a very simple language. 200 persons, please remember, to whom private placement can be made. Sir, on private placement, I have given one case study in my sheets, the notes which I have given. Can we just open and see that case study, what it is? Regarding private placement, if you can come to prospectus chapter, question number 1. Shashank, are you available? Can you
Yes,
read
sir.
this?
PQR Bakers Limited wants to raise funds for its upcoming project. Accordingly, it has issued private placement offer letters for issuing equity shares to 55%, of which 4 were qualified institutional buyers and remaining were individuals. Before completion of allotment of equity shares under this offer letter, company issued another private placement offer to another 155% in their individual names for issue of its debentures. Being public company, is it possible for PQR Bakers Limited to issue securities under private placement offer? By doing so, whether the company is in compliance with the provision relating to private placement, or should these offers be treated as public offers? What if offer of debentures were given after allotment of equity shares but within the same financial year?
So basically, what is happening in this question, that the company had made a private placement offer of shares to 55 persons, but out of that, 4 persons were qualified institutional buyers. So answer yes or no. Can you make private placement to qualified institutional buyers? Answer yes or no. So can you call the QIB issues as private placement offer? Definitely the answer is no. Yes, very good. Answer is no. Okay, and then company issued another 155 shares or 155 persons under the private placement offer. So if you count, the total number should not exceed 200. The total number should not exceed 200 by way of an offer letter. Private placements are always made by way of an offer letter, not by issuing prospectus. So whether the company is in compliance with the requirements of section number 42. Yeah, so let's read the answer. So this information is given in the question. Let's read the answer. Shashank.
According to Section 42 of the Companies Act 2013, any private or public company making private placement through issue of placement offer letter. However, the offer shall be made to the person not exceeding 50 or such higher number as may be prescribed in a financial year. For counting number of persons, QIBs and employees of the company being offered securities under a scheme of employee stock option will not be considered. Further, Rule 14, Sub-Rule 2 of the Company's Prospectus and Allotment of Security Rules 2014 provides maximum 200% who can be offered securities under the private placement in a financial year, though this limit should be counted separately for each type of security. It is to be noted that if a company makes an offer
By
or
each type of
invitation.
security. So this limit of 200 will be counted separately for each type of security. Separately for each type of security. So for debentures, the limit is 200. For equity shares, the limit is 200. Like that way, separately, you have to count the limit. Yes, further.
It is to be noted that if a company makes an offer or invitation to more than prescribed number of persons, it shall be deemed to be an offer to the public and accordingly it shall be governed by the provisions relating to prospectus.
So then it will become a public offer. If it crosses the 200 limit, then it becomes a public offer.
Also, a company is not permitted to make fresh offer under this section if allotment in respect to any offer made earlier has not been completed or otherwise that offer has been withdrawn or abandoned by the company. This provision is applicable even if issue is of different kind of security. Any offer or invitation is not in compliance with the provisions of this section shall be treated as a public offer and all provisions will apply accordingly. In given case, PQR Bakers Limited, through a public company, but the private placement provisions allow even a public company to raise funds through this route. The company has given offer to 55%, of which 4 are QIBs, and hence the offer is given effectively only to 51%, which is well within the limit of 200% from the point of view of the company. From the point of view, the company compliances the private placement provisions. However, as per the provisions, the company has given private placement offer of the benches before completion of the allotment in respect to first offer, and therefore second offer does not comply with provisions of section 42. Hence, the offer given by the company will be treated as a public offer. In case of company gives offer of debentures in same financial year after the allotment of equity shares is complete, then both offers will be treated as private placement.
Very good. So basically, first the company should complete the first offer and then issue the 155 offer to the 155 individuals as debentures. But if the company has not completed the first offer and it is issuing 155 debentures, then 155 plus 51. 55 minus 4 is equal to 51 plus 155. Definitely it is exceeding 200. So if it is not completing the offer, then it is exceeding the 200. If it is completing the offer, then it is within the permissible limit of 200 because it is made for different kinds of securities. Okay, sir. So this is the moral of the whole story, and this case law is definitely bound to come if the question comes on private placement. Tell me, have you understood or not? So with this, we have done a detailed discussion on the prospectus chapter. Okay, because this chapter is a very important topic and high chances of coming in the exam. So now you want to relax for 1 or 2 minutes. Relaxation. Yes, sir. Relaxation for 1 or 2 minutes, then we'll start. Relax. We'll start with the next topic now.
That is better.
Yes, sir. So tell me, discussion, preparation, more important, your preparation, how is it going on? Give me some update. Give me some update. How is it going on? Going good. Good, sir. Very good. Yes, share capital. Next topic, share capital and debentures. So imagine, like fast, all the topics we are discussing. And even though it is crash course, but giving some tips for audit study. Okay, just remind me, in the last class, I have total 4 lectures, correct, in the crash course. In the last class, today is the second one. Let me go through the points. I'll give you proper tips how to study auditing. Remind me, just remind me. I will do that. I will do that. Don't worry. Yeah. Chapter number 4, share capital and debentures. Everybody, can we start? Share capital and debentures. Yes, sir. Share capital and debentures. Tell me, share capital and debentures topic has 2 parts. One talks about shares, one talks about debentures. Okay. One talks about shares, one talks about debentures. If we look in the share capital, what is a different type of share capital? Equity share capital, preference share capital. Definition of share capital is given in 2 clause 84. Underline 2 clause 84. A share is a share in the share capital. 3 times share. A share is a share in the share capital. It includes stock. So when the shareholders invest in the shares, they get the shares in the share capital. When a shareholder invests in the share, they get the share in the share capital. That is called share. A share is a share in the share capital. Okay. And it includes stock. What is the difference between a share and a stock? Come on. Share can be one share. Stock can be group of shares, lot of shares, bundle of shares. Yes or no? Each unit is called, yes, collection of shares. See, it's written there, underline. Each unit is termed as a share, but a group of shares is called as a stock. Okay, bundle of shares, lot of shares. Each unit is termed as a share. So, an important chapter can come in exam. Go down, stock. What is a stock? A stock is nothing but it is a bundle of fully paid up shares. Bundle of shares. A bundle of fully paid up shares is called as a stock. Okay. Kinds of share capital. Section 43, important. Kinds of share capital, equity and preference share capital. Equity shares further have 2 types: uniform voting rights, differential voting rights. Okay. And preference shares always have a preferential right over equity shares at the time of repayment and at the time of winding up, at the time of dividend also. Preference shares have fixed rate of dividend. See, very good question. Can a company only have preference share capital? Sir, no, you will never find any balance sheet where there is only preference share capital. Because a preference share has a preference over equity share on dividend, repayment, winding up time. A preference share have a preference over equity capital. Okay. So how can a company only have a preference share? Unless the company does not have a equity share, on that base only preference share can be issued. So preference share capital can be only issued when the company has equity share, and if the equity share is not there, preference share cannot be issued. Shashank, can you read that answer? Can a company only have a preference share capital?
Which question, sir? Yes,
Page
yes, yes,
number,
yes.
yeah, you got it. 4.7.
Can a company have only preference share capital? It may be noted that while a company
Shashank, it seems there's some network issue from your end.
rights over the equity shareholders, thus, in absence of equity share capital, there cannot be a preferential share capital.
Underline, in the absence of equity share capital, there cannot be a preference share capital because preference shares have a preferential right over equity shares. Okay. Preference shares have a preferential right over equity shares. So in the absence of the share capital, you cannot have a preference share capital. Equity shares with voting rights. Equity shares with voting rights. What is the other name? You know, do you like vanilla ice cream? Vanilla ice cream. Anybody likes? Plain vanilla ice cream. Equity shares with voting rights. You don't like, but have you heard about vanilla ice cream? Equity shares with voting rights are also called plain vanilla. Underline, plain vanilla. See, whether you like or not, your examiner will ask this question. Huh? Equity shares with voting rights are also called as plain vanilla. Okay, not chocolate, vanilla. So equity shares with the voting rights are also called plain vanilla. Underline, plain vanilla. Then they have the same voting rights, one share, one vote. Then differential voting rights are also there. One share, half the vote. So when a company comes out with a scheme of issuing shares with differential voting rights, equity shares with differential voting rights are having less voting rights and more dividend rights. Okay. Here, if you come down, there are some conditions given for issuing shares with differential voting rights. On page number 4.8, rule number 4 of the company share capital and debenture rules 2014. Equity shares with differential voting rights can be issued under some conditions. One, the articles of association must authorize the company. See, without articles permission, without article empowerment, you cannot come with these type of issues. Okay. So articles of association should empower. Ordinary resolution should be passed. Shareholder approval should be obtained. Then resolution can also be passed by postal ballot. Postal ballot, I think we have discussed that you can send the resolution copy at the doorstep of the shareholder. They can vote it from there, and there is no need for the shareholder to come and vote in the meeting. They can vote it directly from their home. That's called postal ballot. Then the differential voting right in the total share capital should not exceed 74 percentage. Please underline 74 percentage. There was an amendment in 2019 August 16. Earlier limit was 26 percentage. So if I show you in the diagrammatic form what was there before amendment and what was there after amendment, the amendment was something like this. The amendment was something like this, that before the amendment came, if this is the total share capital of the company, then out of that, this much 26% can be differential voting right shares. And this was before amendment. And then on 16th of August 2019, there was an amendment. After amendment, the scenario became different. If this is the total capital of the company, then now this much 74 percentage can be issued by way of DVR. So this is the amendment scenario. Okay, sir. So now what you're learning here is this amendment. So for your exam, you have to remember that now company can issue DVR up to the tune of 74 percentage also of the total voting powers. Can we have you understood this point, everybody? Yes, sir. Madhav. Hi, Madhav. Then the company should not have defaulted in filing its annual returns. Okay. Annual returns are which section? Section number for annual return. Come on. Section number for annual return. What is the section number? Section number 92. Yes. Bhavya, very good. Section number 92. So company should not have defaulted in filing its annual returns, annual financial statements. Yes. Form number also people are saying. These people are my students, so they know the form numbers also. You remember all the colorful forms you had drawn? Some were shabby also, but some were very nice. Colorful form numbers. Have you stuck them in on the walls at your home? Holi is coming, no? Colors. So your Holi will be form numbers, okay? Colorful form numbers. Okay, so how many years? 3 preceding financial years. 3 preceding financial years. If the company has not defaulted in filing its annual returns, then only it can issue DVR, otherwise not. That means if you have defaulted in filing your annual returns for consecutive 3 preceding financial year, you will not be allowed to come out with the scheme of differential voting rights. See, there are no conditions for issuing equity shares with uniform voting rights. When you're issuing plain vanilla equity share, then there is no such condition. But if you are issuing shares with DVR, which is not a plain vanilla, then you have to fulfill this condition: 74%, ordinary resolution, postal ballot, no default in annual return, 3 preceding years. Company should not have defaulted in making payments of dividend interest to the preference shareholder, debenture holder, matured deposit. The company should not have defaulted in making payment of any interest on loans, term loans to the public financial institution, state level financial institution, scheduled banks, statutory dues to the employees. If you default in making payment of all these people, then you're not supposed to come out with a DVR issue. Okay. The company should not have defaulted. Why OR is enough for DVR? Because it's a equity share. Don't get confused by the word DVR. It's a equity share. It's a normal equity share. So OR will be sufficient. So every company has to issue equity share, we just now saw. So it's not a big thing to issue an equity share. Your equity share should be there in every balance sheet. Only when equity shares are there, company can think of issuing preference shares later on. Okay. So OR is sufficient here. OR is sufficient. Equity share is the ordinary transaction. It's not a big thing to issue equity shares. Without equity share, the company cannot start its operations. Am I correct or not, Shashank? So OR would suffice here. Okay, sir. Have I answered your question? Can I proceed? Yeah, crediting the amount in the investor education protection fund. If you have defaulted in that, then if you are charged penalties, and suppose if you make good your default, if you read that note in the paragraph, note. Okay, if after the default is made good and 5 years have expired thereafter, so your default is made good and plus 5 more years have been expired thereafter, then you can issue equity shares with differential voting rights. Also, if the company has been penalized by any court of law, tribunal, under any act, and in the last 3 years, so suppose this year I am issuing a DVR, but in the last 3 years I have been penalized by RBI, SEBI, Securities Contract Act, SECRA, Security Contract Regulation, Foreign Exchange Management Act. So all these special acts, if I have been penalized, then I will not be allowed to issue the differential voting rights in the last 3 years. Okay. And then differential voting rights can be converted into equity shares. The Companies Act says that there is a prohibition on the conversion of existing share capital with voting rights into equity shares carrying differential voting rights and vice versa. So both are separate classes of shares. Sub-rule, prohibition on conversion, sub-rule 3. Please underline that sub-rule. Can DVR be converted into equity shares? No. Can equity shares be converted into DVR? No. Both are separate classes of shares. Both are separate classes of shares. Can you make the disclosure of DVR in your board report? Answer is yes. Board of Director can disclose it in the board report. Board report section number 134. Yesterday we discussed. Are you remember board report section number? Then the section number 43, the DVR section, will not be applicable to the public financial companies which are financial financial institution, IFSC companies. Okay. So you remember that a code is there, the banks allot the code to public specified public companies. So to that companies, the DVR issue is not applicable. And if it is a private company where the memorandum of association of the private company provides, however, this exemption is available only to that private company which has not committed a default in filing its financial statement under 137 section and 92 section. So I think the same conditions we studied in ceiling limit also. Then companies have to maintain a separate register of members for differential voting rights. Okay. Sub rule number 6 provides that separate register for DVR should be maintained. Then once the shares are issued, then you have to issue share certificate. Tell me, today any company gives share certificate physical form? Redundant technology, but can come in exam. Don't think it is redundant. Exam, everything is important. In real life, it is redundant. They are saying that a share certificate should be issued, which is a prima facie evidence that you are the title owner of the shares. And the share certificate should have a common seal. Nowadays, common seal also is not required. It's optional to have common seal. CA Foundation, you must have studied. Then it should be signed by 2 directors, or it should be signed by 1 director, 1 company secretary, if a company has appointed a company secretary. So common seal is not needed, as you know, if 2 directors sign or 1 director sign, 1 CS sign. So common seal is not required. So this was a common seal is made optional for the companies from the Companies Amendment Act 2015. It is given here. Date is also given. Then can the shares be held in the demat form? Yes, you can keep the record of shares in demat form. Your name, your depository's name will appear in the record of the share capital. Even if the shares are held in the demat form, you will be the prima facie owner of the shares. You will be the beneficial owner of the shares if the shares are kept in demat form. Can the originally issued share certificates be renewed? Answer is yes, it can be renewed. If it is defaced, if it is mutilated, torn, destroyed, renewed, share certificate can be issued in replacement of the original share certificate. And then if you have the mutilated share certificate with you, you can surrender it to the company. Can a company issue duplicate share certificate? Yes, duplicate can also be issued. Again, the reasons are same: destroyed, mutilated. If the original share certificate is destroyed, lost, then you can get a duplicate share certificate. Company can charge you rupees 50 per share certificate. Underline. Companies can charge you not exceeding rupees 50. For that is basically the printing cost of share certificate they are charging. And if it is a duplicate share certificate, then on the face of the share certificate, it should be prominently printed duplicate. it should be prominently printed as duplicate issued in lieu of the original share certificate. Okay. And the company has to maintain record of the duplicate share certificate in form number SH2, underline form number. It should be a register of duplicate share certificates. And all the entries in the register should be authorized by the company secretary. The CS will be appointed for. CA and CS have both equal importance in companies nowadays because so many formalities have increased. Share certificate can be held in physical form or it can be held in the depository mode, electronic form. You all people know about it. The share certificate should be issued only when it is authorized by the board. If the company is issuing bonus share also, then also share certificates can be issued for bonus shares. How should the share certificate format look like? The certificate of the share shall be in form number SH1, which should have the name of the person in whose favor the certificate is issued, number of shares, and amount paid thereon. These are the 3 points: name, number of shares, and amount paid thereon. Share certificate. Then you have to maintain separate share certificates at the registered office. If any case is a disputed case, suppose title dispute between two brother, dispute is going on regarding who is the title owner. So in such cases, you can preserve the share certificate up to 30 years. But if it is a disputed case, then you can preserve it permanently. Underline. So for how many years the share certificate shall be preserved? Maximum duration is not less than 30 years. Underline 30. It is not books of accounts. Books of account 8 years. Auditor working paper 7 years. Share certificate 30 years. But if two brothers are fighting disputed matter, then permanent preservation. Disputed matter. If somebody has surrendered the share certificate to the company, then just like how we write cancelled, you have to write cancelled. Share certificates are not like negotiable instruments. They are not negotiable instruments. They are marketable and tradable securities. Please remember, share certificates are marketable and tradable securities. Company can issue only one share certificate in all the cases where shares are held by more than one person jointly. Sir, joint ownership, private company. Joint owner in private company will be treated as single member. Yes or no? In counting 200. In counting 200, sir, in private company, ex-employees are not to be considered. Okay. Ex-employees, present employees not to be considered in counting 200 because we don't get anything from employees. And while we are computing 200, we have to count joint owner as single members in a private company. This can come in exam. It came in the recent inter-CA paper. This case study came in the recent CA inter paper. Students will study advanced things and examiner is cunning enough to ask you recent case studies. See, look at this question. Question number 2, private company question. It's a previous year exam question. I've already written here which year it came. It came in May 22, recent exam. I always write which exam it has come. So you can see in front of you it is. Mark it, important question. Private company calculation. And see, it is given here also that members are holding shares jointly. So there are 14 members. But since they are holding jointly, we will divide 14 by 2. So we'll count them as 7 members. Okay. We'll count them as 7 members. Employees not to be counted. So we'll only count directors, ex-employees and employees not to be counted. We'll count members and we'll count other members. So 18 plus 7 plus 137. 18 plus 7 plus 137. Is it exceeding 200? It is 162. If it is 162, it is less than 200. Yes. 162, less than 200. So there is no need for reduction of the members because already the members are below 160, below 200, that is 162. So this is a MNP is a registered public company. Now it wants to convert into private company. The question is, can the company be converted into private company? Yes. Can the question is that is there any need to reduce the number of members? No, no need. There is no need because already the number of members are less than 200, that is 162. So why you want to reduce it? Private company can have maximum up to how many members, sir? Section 2, clause 68, 200 members. Section 2, clause 68, how many members, sir? 200 members. Tell me, are you understanding or not? Okay, so that joint ownership concept comes. So we discuss this case study. Now, if the company, coming back to our share capital chapter, if the company defrauds in issuing share certificate, duplicate share certificate, if the company has defrauded in issuing the duplicate share certificate, then 5 times the face value of the share is the minimum fine on the company. Higher of 10 times the face value of shares or rupees 10 crores. Maximum fine can be higher of 10 times the face value of the share or rupees 10 crores. Deadly, deadly fine, sir. And every officer on the company will be liable for fraud action, defrauded, na? So fraud. 447 section again came. Tell me 3 places where 447 section comes. Can you tell me 3 places? Any intelligent student can answer this question that 447 gets attracted at 3 places in company law. Which are those 3 sections? Anybody? I was discussing yesterday 34 misstatement in prospectus. Very good. Yesterday I was discussing one section 140 subsection 5, removal of auditor by NCLT. 140 subsection 5, removal of auditor by NCLT. Correct, sir? And sir, 46 section, share certificate section. Section 46, remember. Write it, sir, write it somewhere. 447 gets attracted at 3 places. Removal of auditor, 140 subsection 5 by NCLT. Okay, sir. And 46 section, that is issue of share certificate. And which other section, sir? 34 section, misstatement in prospectus. Correct. 3 sections you have to remember where 447 gets attracted. Tell me, are you understanding or not? Then tell me, every member of the company holding the shares will have the right to vote? Answer is yes, voting rights are given. Tell me, which shareholder have voting right? Section 47 subsection 1 says equity shareholders will have voting rights. They can vote by passing resolutions at the meetings. Okay, sir. If he is voting on a poll, he shall be in proportion to his share capital, equity share capital. So in polling method, voting rights are proportionate basis in proportion on the poll. But if it is other than poll method, then it will be on how many shares he is having. So 1 share, 1 vote, 2 shares, 2 vote. Please underline the word poll, proportion method. In case of Nidhi company, no member shall exercise voting rights in poll in excess of 5% of the total voting powers. So Nidhi company, there is a threshold limit of 5%. For other than Nidhi companies, you can exercise as per your proportion of vote. So if Rakesh Junjunwala has major shares of Titan company, and if the poll method is used there, polling, nowadays you must be seeing now elections are coming, poll method is used. So poll method, in that voting rights are always in proportion. Okay. You can vote as a member in any meeting, even by postal ballot you can vote. Even by postal ballot you can vote. If you are holding preference shares, then subsection 2 of 47 says that voting rights are not available to preference shareholders. But if their rights are getting affected, if their rights are affected, underline A point, affecting the rights to the preference share, company not giving preference dividend, company not doing redemption of preference share, if the rights are affected, then preference shares can vote. Preference shareholders can also vote in the event of winding up of the company. In the event of repayment of the share capital redemption, they can vote. So only when rights of preference shareholder gets affected, they can vote. Even preference shareholders have an option of polling method. But in polling method, they can vote even if they are a preference shareholder in proportion to his share. So a proportion in polling method applies to both, whether you are equity share or whether you are a preference shareholder. So proportional method applies to both, whether you are equity share, whether you are a preference shareholder. Summary of the voting rights. Equity shareholders, every resolution, they will have voting rights. And if they have differential voting rights, then it will be defined in the articles. Differential voting rights will be defined that one share is equal to half vote, one share is equal to 3/4 vote, because differential voting rights are compensating for voting and enjoying more dividend rights. Correct or not? And shareholders, preference shareholders, for normal method, there is no proportion counted, but for poll method, there is proportional counted. Voting will be exercisable when dividends are not paid for 2 or more years. Preference shareholders can vote when company is not, and especially if they are cumulative preference shares, they can accumulate the dividends. And in case of winding up also, preference shareholders can vote. And if their interest is directly getting affected, then also preference shareholders can vote. Yes or no? There is one example given that there is one pharma labs which has raised 300 crore by issuing a single series of 8% preference shares apart from 1200 crore of ordinary share. So there is 1200 crore of ordinary share and 300 crore of preference share. So 4:1 ratio. Equity share is 12, that is 4, and preference share is 3, that is 1. So 4:1 ratio. So preference shareholder with effect from 1st April 2022 shall assume that the right to vote on any resolution passed before the company, but till 31st March 22, they can only vote on resolution that directly affects their right. So there is a new point which has been inserted, that preference shareholders are allowed to assume the right to vote on any resolution, underline the word any resolution. Prior to 1st April 2022, they can only vote if the resolution affects their right. Okay, that suppose redemption problem is there, but then preference shareholders, even if they are voting for any resolution, they will be given proportion voting rights to equity shares. So in this case, if any resolution is passed, so they will be only having one voting right in comparison to equity share who have 4 voting rights. So they can now vote on any resolution, but till 31st March, they were only allowed to vote on those resolutions where their rights were getting affected. Tell me, have you understood or not, sir? Fantastic discussion. Is it clear to everybody, sir, so far? Yes, sir. So company law will become easy. 60 plus exemption. I want everybody to score 60 plus. So we have started with share capital chapter. I would want to continue with my discussion in the next class also. I hope the discussion was useful today. Prospectus and share capital we discussed. And enjoy your studies. Thank you so much. And I wish you all the best. Bye-bye. I'll see you soon. Thank you so much. Bye-bye. Thank you. Thank you. Aditi, please message me your doubts. I'll be happy to solve your doubts. Please message me. I'll be happy to solve your doubts. Don't worry. Thank you so much. Thank you. Thank you. Thank you. Thank you. Bye. Bye. Bye, Anurag. High five. Bye. Bye, Trupti. Bye. Yes, I will get it done. Anybody who has not got the case studies, I'll get it done. Bye bye. Hardik, thank you. Bye bye. Thank you. Yes, please message me your doubts. I'll solve it. Madhav, bye bye. Thank you. Thank you so much.